Hello, everybody. Hello, everybody. Welcome to APT Global's webinars. This is a series of webinar we are doing to enhance and enrich the understanding of UAE VAT, which is the first tax year. I would like to introduce APT Global partner, Mr. Ayub Shamali. Ayub is a chartered accountant from England and Wales, and he holds the audit license in the country UAE, and uh, he has written a book on UAE VAT also, and I would like him to introduce about this enriching topic. Welcome, Ayub.
Good morning, everybody, and good afternoon. Thank you very much, Otam, for the introduction. My name is Ayub Shamali. I am partner in APT Global, and our topic today is the tax group under UAE corporate tax, the new corporate tax law, which is implemented in the United Arab Emirates. I will start with giving you some background about what are the group of companies means, or what kind of forms and characteristics of each group of companies that we can define. Can you go to the next? Swami, can you go to the next slide, please? Next slide. Okay. Okay, so there are different form of group of company or business groups. So we can say that one of the form is common management. There are some different companies with the common management. For instance, I remember I did an audit or for a company which is near my home. It is an industry business. There are two companies actually, and they are doing they are producing two different products, and everyone thinks that they are the same company. When I did the audit for them, I realized that they are different companies, different owners. The only thing that they are in the same area, and the board of director, they have a common board of directors, and there is no relation with the company. So they look like a group of companies, but they are in fact separate legal entities with common management. The other form of business could be the franchise. Franchise, now I'll give you example, is Subway or KFC or McDonald's. So, and people perception that they think that this is a single company or a single entity, but in reality, franchise is just given a licensing right to use the name, and each franchisee is a separate legal entity, has its own assets, has its own financials, but they have the right to use the name of franchise. Another form of business could be also a common common interest or activity or corporate alliance, where there are where we see it commonly in the industry of consulting or learning, where there are a lot of alliance between entities. They give trainings on behalf of others, and but it formed like a group. One more, or the most important, is a form of business is a group of business based on ownership. So in accounting principle, for So as per the accounting principle, a group of company refer to a collection of parent and subsidiary or subsidiaries that are considered as a single economic entity for financial reporting purpose. The parent company, which has the owner and who has the control and interest in the group, is one or more is controlling the business, and the financial statements are usually consolidated given this, some criteria and conditions are met, which I will explain, not in very details. The consolidation involves combining all the assets, liabilities, and expenses, and that I will not go into that all details. So there are three sorts. There are for ownership. There are three type of ownership. First type of ownership is investment, 20% shareholding, which is considered as either available for sale or trading for trading purpose. So in this the percentage below 20%, the company only recognizes the movement of the price of shares. For example, I purchased shares of 10% of company X. By the end of the period, we will recognize the change in the either increase or decrease in the value of that share. The other form of ownership is the associate, which is from 20 to 50% ownership. An associate, the company will recognize the profit and loss of that company, plus it will recognize any dividend paid. And of course, impairment will be considered in this case. The third part is a parent company and subsidiary, which where the parent control has more than 50%, which is a controlling interest. So in 50% ownership, the company will provide the consolidated financial statement. Below 50, usually the company will not have a control interest and therefore will not consolidate. So these are the some form of group of companies, generally in business and as per the accounting principle. However, this is not the case for tax group. In tax group, there are different criteria, there are different conditions to be met, and there are some advantages and disadvantages for being in a tax group. That we will hear now from Avinash Gupta, who will explain in details how tax group, what are the benefits of tax group and what are the characteristics.
So thank you, Ayub. Yeah, over to Uttam. Yeah, so tax group as a concept in taxation is a bit, it's an advanced concept. And a lot of countries have come up with the concept, including Ireland, now UAE, and a lot of European unions have introduced this concept. So the concept says that whenever there are common parent and a threshold of a percentage, each country decides. If it is more than the threshold limit, the company or the parent company can opt to file a group tax return, whereby all the subsidiaries which are below that parent need not file individual return, and only one return can be filed, and the compliance becomes easy. So this is the concept, and let us see in UAE how does it work. Next slide. So there are 5 conditions as per the UAE city law, which needs to be fulfilled to form a tax group. So let us take one by one. What are these conditions? The first condition, the foremost important condition, is that all the members in a tax group should be a juridical person. That means a natural person or a sole establishment cannot be part of the tax group. And this condition is important, being that all the juridical person who has the common parent can become part of the tax group. The second condition for forming a tax group is that the parent company holds directly or indirectly. So indirectly is a very wide term. We will deal with that in detail in the preceding slides. Should have at least 95% of the share capital or the voting rights of all the subsidiaries. If this condition is satisfied, they can part, all the subsidiaries can be part of the tax group. The third condition is the parent company, which is an extension of the second condition, is entitled to directly or indirectly at least 95% of the profit or net assets of the subsidiaries. So uh, this condition is a sub condition for, or in addition to condition B, wherever if somebody is not able to hold direct share, this condition is also addendum to that second condition. The fourth condition is none of the companies within the tax group should be an exempt person or a qualified free zone person. So when we say qualified free zone person, the juridical person who wants to take the tax benefit of 0% cannot be part of the tax group. However, if any free zone person who doesn't want to opt for qualified free, or it doesn't opt for the beneficial tax rate of 0%, they can be part of the tax group. The fifth condition is the accounting standard, the accounting year, and all the other should be common for all the companies which are within the tax group. So these are the 5 conditions. And what we will do is we will see one by one how, with examples, how these conditions or how this way actually work practically. Next.
So friends, what we have seen is the tax group. So it is a more modern concept, and many of people are not aware about that. So the basic objective is that if a group is having 50 entities, 10 entities, 100 entities, so now why to assess for tax purposes each and every entity? So if they are working as a group and they are also doing a consolidation of accounts, so then why not to do an tax assessment of as a group as a whole? So it will reduce the compliance burden. It will reduce the assessment burden of the government as well. Plus, it will also help in doing the compliance with some anti-abuse provisions like transfer pricing. So my friend and my colleague Swami is also here with me. So Swami, you will be please be with me, and if there is any questions in the chat box, if anybody have any questions, so please ask that question whenever it is there in the chat box or a Q&A box. So that is a request to you. And wherever you want to add anything, then do it. So so that is the concept of the tax group which have come. Now, every country have their own way of dealing with the tax group. Some countries say if you have 51% or more, then you can form a tax group. Some country have a provision of what we say is the beneficial ownership. So even if you do not own a company 51% or more, but it is beneficially owned by another company, then also you can create a form a tax group. Some countries have a provision of 75%. But UAE have a unique provision of 95%. Now, what UAE says that not only the shareholding, so there has to be a holding plus there has to be share of profit. That I may be holding 95% of or more a company, but I am having a right to have a share of profit only 50%. So for example, Ayub and me, we open a company, my share is, let's say 4%, Ayub's share is 95%, 96%, but in the profit sharing, we are 50-50. Or maybe some countries have made a law like that, wherever the local person, the local citizen may have a more shares, but profit sharing is 50-50. And in UAE, we know that local sponsors are there in every business, though they may not be required now, but earlier it is required. So because of that, the legal ownership might be with the local sponsor, but the beneficial owner is with me. And in many cases, even the 100% profit belongs to me after paying a small fixed fees to the local sponsor. So I may be the 100% beneficial owner of the company, but on papers, I may not be 100% legal owner. So the FTA and the law, the UAE government have made it very clear that the person to create a tax group has to have at least 95% of the legal ownership, and they should also have at least 95% of the profits and assets of the company. Even in case of liquidation, if I am not entitled to receive more than 95% of the assets of the company, then also I cannot form a tax group. So that is one is very, very important test that what we need to see. Next, then they put a restriction that any company, even if 100% owned by another company, beneficial owner, profits, asset, everything is there, but that company is a qualified free zone person, meaning thereby they are going for 0% tax for their qualifying income in a free zone, provided they all qualify, they all justify all the fulfills all the conditions which have been specified there in that particular law of relating to free zones. So I'm not going in that. In our last webinar, we have done a extensively discussion on those free zones. And then now the FTA have also come up with a new guide on free zones. So maybe our next seminar would be on that only. But if they are qualified to be a free zone person, then that free zone entity, who is a qualified free zone entity, cannot form part of the tax group. Now, it might be possible that we have a company which is set up in a free zone, but we ourselves don't want to claim the exemption, or we say we do not fulfill any of the condition, hence we are not qualifying free zone person. Then in those cases, if the person himself or the company itself have applied for a 9% corporate tax rate, then yes, in that case, they may go and they may say that we can form a part of the qualifying group. So if I am not a qualifying free zone person, then also I can be part of a tax group. Then it might be possible that some owner of a company or a group of companies have sole establishments also. So there is a Mr. A, let's say Mr. Uttam Patel sitting next to me, he is having 100% ownership of a company. That company have another 100% ownership of another company. That company may have another 100% ownership of another company. Plus, he also have a sole establishment, which is owned by him. So he can create a group for his company below it, and a company below it. Three can be done. But can this sole establishment be form part of the group? Answer is no. So the group can be created only for judicial person. It cannot be created for the natural person. And sole establishment, we know, is not a judicial person for corporate tax purposes. The sole establishment has to be added with the natural person. So hence that sole establishment cannot form part of the group, or any individual, any natural person, if they have any income, then they cannot form a tax group for their income that they have earned as a natural person. So that is also prohibited. So these are the three conditions what I put: 95% or more shareholding and profit sharing and assets. There should not be a qualifying free zone person. It has to be the natural, it has to be a judicial person. Natural person cannot form part of the qualifying group. The only condition that one has to fulfill is that they should follow same accounting year, and they should also follow the same accounting standards and policy. So in the group, if one is the full IFRS and another is using IFRS for SME, and the third one is not using anything, those who are not using any standard, first of all, they have to use IFRS, because the law says that every company who is liable for corporate tax has to follow either IFRS or IFRS for SME. But if in a group, some companies are using IFRS for SME and some companies are using full IFRS, then everybody to form a part of the tax group, everybody has to follow the same accounting principle, meaning thereby they have to go and create and form the one IFRS for all the entities which are part of the group. So this is the precondition that one has to follow, without which we cannot form a group which is a tax group. Any questions, friends? If you have, we can answer it. Then
Sir.
I will tell you one more thing, which is there is a confusion among all the people that what is the difference between a tax group and what is the difference, and there is another term used in the law which is called as a qualifying group. So before we go into questions, I think I should clear that particular doubt, that what is a qualifying group and what is a tax group. So a tax group is a group which is there for tax purposes, where 95% or more plus other conditions are satisfied, and there has to be a single return, there has to be a single assessment, and the payment of tax has to, or it should also be at a one place. That is what is being required for a tax group. However, qualifying group is a separate concept which is used in the corporate tax law or the law in the UAE corporate tax, where they say that if there is in a group which is not a tax group, once it is a tax group, then everything is automatically consolidated. But if there is a company which is not a part of a tax group, whether they have 95% or not, that doesn't matter. So they say that for a qualifying group, there has to be minimum 75% shareholding. So if there is a company which is 100% owned by us, 90% owned by us, or more than 75% owned by us, and that is not part of the tax group, the group or the company may take the benefit of the losses of that particular company. That is called as a qualifying group relief. So if a company which is not a part of tax group, but there is a 75% or more share capital of that company, then we can take the benefit of the losses of that company subject to certain conditions to be fulfilled. Then it is called as a qualifying group. Tax group, whatever it is, if you have 95% or more, if you are not a natural person, if you are not a free zone person, then everything subsumed under one, and it will be treated as one tax assessee, one tax person, but only one filing that is to be done. The only exception that they have given in this law is, even if there are 2 companies, 4 companies, 5 companies in a tax group, but whenever the withholding tax compliance would be introduced in UAE, each company has to do withholding tax compliance separately. Other than withholding tax compliance, everything is taken at one place, including the transfer pricing compliance, including the return filing compliance, including all other compliance what the FTA have already notified or it will notify in future. So withholding tax is something which continues to be done at an entity level. Other than all, it will be a single compliance to be made at group level, which is called as a tax group. Yes, Swami, any question?
Yes, sir, there are.
Or you want to add something here?
Yeah, so all. So I wanted to hear that all these conditions, all these 5 conditions, should be satisfied throughout the tax period. Even if it is absent for 1 day, then the benefit of tax group provisions will not be available. So that is very important. And the second thing is either a parent or subsidiary. A single entity can be a part of a single tax group only. It cannot be part of multiple tax groups. A parent company cannot form a tax group, one tax group with one subsidiary and another tax group, another subsidiary. It cannot form. So either parent or subsidiary, it can be part of one tax group only. So these 2 are the important things to remember here. So, sir, there are few questions in the chat. Can I ask? You are on mute.
Yeah, please carry on.
Yeah. So first question is, if a subsidiary company is controlled by 95%, but subsidiary company is in another country, let's say Saudi, still we have to consolidate books and submit tax.
So I think I have made something wrong here. So one more condition is that only a UAE resident company can form a tax group. So any company who is not a resident of UAE cannot be formed part of the tax group. So a Saudi company owned 100% by a UAE company cannot be part of the same tax group.
Yes, sir. The second question is, I think it is related to compliance. Is it mandatory? Do we need to register for each entity in the tax group separately?
Yes. So the FTA have clarified this point And FTA said that every company of a tax group, first they have to register with the FTA as an individual entity only, and the due dates have also been prescribed for various entities. After creation of the individual CT registration or corporate tax registration for each entity, then up to 31st of December we have time. But before that, end of the tax period or end of the tax year, we need to form a tax group by using all the TRNs of the entity, and one of the TRN should be the representative who will be at the top holding level. So that should be the representative of the tax group.
Another question is, company A is in Jabja and company A holds 100% in company B and company C, which is a mainland, which are in mainland UAE. So whether tax group formation is allowed.
I have already told you, I believe the Jabza company is a free zone company and maybe doing all kind of satisfying the condition and maybe regarded as a qualifying free zone person. The moment it is a qualifying free zone person, that cannot create a tax group, and the company A and B which are below Jabza is not owned by each other, which is owned by a free zone person. So in that case, I don't think that they can form a tax group. However, if Jabza company is foregoing its exemption and they say that, okay, we will be liable and we are ready to pay 9% corporate tax under the CT regime, then yes, all three can create a tax.
Yes, so there is another question, but it is not related to tax group per se. So is it mandatory for the offshore companies to do a CT registration?
I think the FTA have already answered to all the people that they have not yet started registration for offshore Jabza company and civil company in UAE. So they have written emails back to all the people. Once you write an email to FTA, they will reply you that they have not yet started Jabza offshore and this civil companies in UAE. One more thing, friends, even if Jabza offshore companies are liable to be registered here in UAE, but they are liable to pay tax only on the income which is attributable to UAE, or there has to be a poem which is situated here in UAE, or there has to be a permanent establishment in UAE, then only they are liable to pay tax. Merely a Jabza company which is registered in Jabza as an offshore entity and holding only a bank account or holding some assets there does not per se give rise to any kind of an income to be taxed here. So I think FTA is exploring all those things. So once they will allow us to do a Jabza thing, then we will do it. For example, I think 3 days or 4 days back, they have allowed foreign holding as an option given in the earlier. They do not allow us to go for a foreign holding tab where we say. So for example, there is a UAE company 100% owned by a foreign company. So earlier we are registering them as an other. Now they have allowed us, there is a tab where we can select a foreign registered company who is owning UAE company, and we can upload the license of that foreign company also, so that they have allowed it. So I think in a due course of time, this Jabza offshore companies thing will also be clear. But as of now, once you can write a mail to FTA and then they will reply it back. Yes, Swami.
That's it, sir. I'm moving to next slide.
Okay, next slide. So I think this is an example which is there, which I think we have already discussed. So there is a parent company who is a UAE parent company. Under that parent company, there is a UAE mainland company. Can it be form a tax group? Answer is no. Then there is a non-resident subsidiary. What I think one of my friend have just asked this question about the Saudi company hold 100%. Even that cannot form a tax group. Then there is a qualifying free zone person that is already we have discussed that cannot form part of it. Then there is an exempt person also. So there is no there is an exemption to be given to them. Then they can also not form part of the group. The last is the mainland company, which is a 100% subsidiary, and below that mainland company there is another subsidiary. So parent company, mainland subsidiary 100%, and UAE mainland subsidiary 100%. So these three companies can form part of the tax group, even though all has to register individually as well. So that is what we can say about it. So Ayub, do you want to add anything? So you were free to add if you want to add anywhere. Next. Next, Swami. Swami, can you take this example? I think this is from
Yes,
the
sir.
guide.
Yeah. So this is just an example representing whether a foreign parent company or a foreign group can form a tax group in UAE. Yes, in some cases where there is a intermediary parent in UAE. So we will see an example. So company F, which is outside UAE, which is the ultimate parent entity. So which holds 100% shareholding in company E, which is in UAE, and company E in turn holds under company A, company B, and company C. So here there is a common parent in UAE, which is company E, and there are subsidiaries in which it is holding more than 95% of shareholding. Assuming that all other conditions are satisfied, company E, company A, company B, company C can form a tax group in UAE and can be treated as a single taxable person and do all the compliances as a single taxable person. So we'll move to the other examples which further clarify various nuances in conditions we discussed in the first slide. So this example is more about the legal ownership, so which we already stressed in the first part that there should be 95% should be legal ownership, and it is not the beneficial ownership. We'll see. So here company A holds 80% in company B, company C holds 20% in company B. If you see individually, company A is neither holding 95%, company C is neither holding 95%. So here we cannot form any tax group. But here there is one condition that there is an agreement between the company A and company C that company C will transfer 20% of its beneficial ownership to company A, thereby company A will hold 100% of beneficial ownership in company B. Whether in this case can company A and company B form a tax group. So again, we are reiterating. So it should be legal ownership, not the beneficial ownership. Here, legal ownership is still 80%. Beneficial ownership, the beneficial ownership of 100% is not relevant here. Therefore, company A and company B cannot form any tax group. And this example depicts how to calculate that 95%, whether it is based on the number of shares or nominal value of shares. So in this example, you can see that the company A has issued two classes of shares, class 1 and class 2. Class 1, 100 shares, 10 rupees nominal value, and total capital is 1000 AED, and class 2, 1 and nominal value is 1000 and total capital is 1000. Total is 2000 AED. So company B holds 100% of class 1 shares of company A. So if we apply the formula based on the number of shares, it is more than 95%. It's almost 99%. But if you apply the total capital, it is only 50%. So we should only consider the nominal value, not the number of shares. So applying that, it is only 50%. It is less than 95%. So company B and company A cannot form a tax group. Yeah. So this example is clarifying the holding ownership indirectly. So the ownership of 95% or voting rights or the entitlement to profits or net assets can be done through can be have indirectly also. It need not be directly, can have by indirectly also. So this indirect condition has another caveat, that is that the indirect should be through another subsidiary. Subsidiary means the subsidiary in which the parent company should have at least 95%. It is not a normal subsidiary where we will have more than 51% as per IFRS or any other standards. It is the tax group related subsidiary where you should have a more than 95%. So we will see this example, you will get an idea.
Yeah. So,
So-
Swami, just 1 minute. So, friends, if you see that in company C, company A holds only 80%, and in company B, they holds 90%. Remaining 10% is also held by A indirectly, but through company C. So practically, when we see company B is owned 100% by company A, 90% directly and 10% indirectly. So what FTA wants to say in this example, that company B is owned less than 95% directly, it's okay, no problem. But they owns 10% through C, and C is not owned directly by A. So hence, A, B, and C cannot form a tax group. A and B also cannot form a tax group. But now let me change this formula slightly. Let's say company A holds 95% of company C, 5% let's say others, and company A holds 90% of company B, and C again holds 10% of company B. If this is the situation, then in that case, A, B, and C, all three can form a tax group. So FTA is trying to say that if we are holding indirectly in any company, that indirect should also be formed part of the tax group. If they are not able to form part of the tax group, then they cannot do so. So then the tax group cannot be formed. But if within the tax group somebody there is an interholding, one company is holding another is holding another, like that, then yes, they can form part of the tax group. That is what the FTA wants to say in its guide on tax group. Over to Swami.
Yes. So this example is just clarified by Avinash sir. So this is the same thing. Company is holds 95% company B, and this is slightly different. I'll just explain. So where subsidiaries are held by the parent, which are not wholly owned subsidiaries. So in this example, company A holds 95% company B, and company B holds 95% company C. Whether company A, B, C can form tax group, or company A and B can form, or B and C can form. We will see. So in the first case, company A holds directly 95% company B. Yes, it can form a tax group, company A and company B. And if you see below, company B holds 95% in company C. If individually, company B and company C can form a tax group. But whether company A, B, C can form, we will see the competition. First, company A holds 95% company B. But if you see whether company A holds indirectly 95% company C, so 95% of, we should calculate 95% of 95%, which comes to the 90.25%. So which is less than 95%. So company A, B, C together cannot form a tax group, but individually company A and B can form, or B and C can form. Yeah. So this is the another example which incorporating all the things we have learned in the previous examples, which shows the.
I think there is some bandwidth problem.
Hello.
So I'll take this example. I think there was some bandwidth problem, so we are not able to hear you properly.
Oh.
Okay. Swami, I think there is some bandwidth problem. So now I can. So come back, Swami, come back to the earlier example. So, Swami, come back. The earlier slide. Hello. Come back.
No,
Example 5. Yeah. So friends, if you see, example 5.
I come to example 5.
So friends, what happened in this? If you see, company A owns 95% of B, and B again holds 95% of C. So there is no doubt A and B can form a tax group. There is also no doubt B and C can also form a tax group. Now the question is, can A, B, and C all can form a tax group? So then we have to test it. So company A owns 95% or more of B. Yes, A and B can form a tax group. Now let's come to C. Can company A directly or indirectly owns 95% of the C? Answer is no, because effectively company A is holding 95% of 95% share, which is coming to be 90.25. And one of the condition there in the uh, law is that A should hold at least 95% of C. So hence A, B, C, all three together cannot form a tax group. Now suppose A owns 100% of B, B owns 95% of C. In that case, can they form a tax group? Answer is yes, they can form a tax group. Or reverse, A owns 95% of B, B owns 100% of C. In that case also, A, B, C can form a tax group because A is effectively owning 95% of C in those cases. But in the present situation, A is not owning 95% of C. It is rather owning only 90.25% of C. Hence, A, B, C cannot form a tax group. But yes, A and B can form a tax group, or B or C can form a tax group. That is what this example states. Over to Swami.
So now you are able to hear me, sir?
Yeah, yes, I can hear you.
Yeah. Yeah, so this example is after incorporating all the issues we have seen in the previous example. So this is a clear example where company A holds 95% in company B, which satisfied the condition of 95%. And whether it satisfies the condition of holding 95% indirectly in company C, we will see. So indirectly it holds first through company, directly it holds 50%, and indirectly it holds 50% through B. So 50% plus 95% of 50%, that is 47.5%. So 50% plus 47.5%, total is 97.5%. So company is holding 97.5% in company C directly and indirectly. So company, in this case, company A, B, C together can form a tax group subject to satisfaction of all other remaining conditions. So we'll go to the next example. Yeah. So this is transfer of shares between the members of tax group. So what if during the tax period, if shares of one entity is transferred within the tax group to the another entity? We'll see what happens. So in this example, company A holds 100% in company B and company C directly, and company B holds 95% in company D, and company C and company B holds 95% in company D. So during the year, so let's say in this example on 1st December 2024, so company B transfers this 95% stake in company D to the company C. So company C will have this 95% in company D at the end of the tax period, that is CY 2024. So in this case, in the first slide, we clearly mentioned that the condition of all these 5 conditions should be satisfied throughout the tax period. So in this case, if you see company B transferred this 95% to company C during the year, whether it is a violation of satisfying all the conditions throughout the year, we will see. So if you see in the first case, company A directly holding in company B satisfied, and company B and company D and company A indirectly holding 95% company D, that is 100% of 95, that is 95%. So A, B, D, A, B, C, D are part of tax group. And if you see after transfer, even after transfer of 95% by company B to company C, the stake in company D, it is still satisfying the condition of holding 95, the condition of holding 95% in company D by company A, because company A holds 100% in company C, and company C in turn holds 95% in company D. So indirectly, company A holds 95% in the company D. So there is no violation of that condition of satisfying all the conditions throughout the tax period is not violated. Therefore, still the tax group can continue for CY 2024 and the future tax periods. We will go to the next example. Yeah, so we have seen that the one of the conditions to form a tax group is the parent entity should means the entity, the parent entity should be entitled to at least 95% of profits and distributions. So we will see how that impacts a tax group. So in this case, company C is incorporated and the tax resident of UAE. The share capital is as follows: the ordinary shares, they have 100 number of shares, 10 AED each and 1000 AED in total, and preferred shares 1 and 50 per share, and total is 50 AED. So the total capital is 1050 AED. So here all the ordinary shares are held by company A and all the preferred shares are held by company B. So you know that in case of a preferred shares, they have preferential rights and their preferential rights with respect to entire profit and also the liquidation proceedings in priority to the ordinary shareholders. So in this example, company C uses the Gregorian calendar year, that is the calendar year from 1st January to 31st December. So we will see two cases and how it will impact a tax group. First, we'll see in 2024 scenario. For example, in 2024, company C reports a profit of 83 million, which if distributed, would be distributed like 2.86 million. That is just a proportionate amount to their total capital. That is 3 million into 1000 by 1050 to company A and 3 million into 50 by 1050 to company B. That is the preferred shareholder. So in this case, they are getting the shares as per their ratio, means their shareholding. So in this case, the ordinary shareholders are holding that 95% and they are getting their entitled to profits also at 95%. So there is no violation on prima facie. So we will see in that next slide. We'll go. Yeah, you can see that in 2024, company A meets the shareholding ownership condition, that is 95%, and also profit condition. Company A would also meet the net assets condition, provided it would be entitled to 95% of proceeds. So if company C were to liquidate it. So assuming all other conditions are met, so company A and company C as of 2024 can form a tax group. So the whether at the time of liquidation, whether it will be entitled to 95%, all this we cannot determine now. So we have to see only the theoretical possibility, not the practical possibility. So in 2024, company A and company C can form a tax group. We'll see the next scenario in 2025. So company C makes 80.1 million profits, which if distributed would be distributed fully to company B. So as per whatever the agreements or whatever arrangements they have, if they have to distribute, they'll distribute fully to the company B, which is the preferred shareholder, since it is a preferred shareholder. So in this case, if you see the ordinary shareholders, that is the company A, is not entitled to any profits. That means one of the conditions of that entitled to 95% profits is violated. Therefore, for 2025, it cannot form a tax group. So, and the tax group shall notify the FTA within 20 days from the date on which these conditions are no longer met. So from that date, within 20 days, it should notify the FTA. So we will see another example, which is in relation to the tax period. So one of the conditions to form a tax group is the financial year should be same for all the members of a tax group. If it is different, there is an option to apply to FTA to change the tax group. FTA has specifically mentioned in its guides that it will allow for change in tax group. And one of the reasons that is if it is part of if that particular entity is part of a tax group. So in this example, you can see that company A as a Gregorian calendar year that is ending on 31st December. Company B has a financial year that ends on 31st August. On 3rd May 2024, company A buys all the shares in company B. So from 3rd May 2024, they are having this legal ownership of more than 95%, assuming that all other conditions are satisfied. It gets the option of forming a tax group, but here the tax periods are different. The financial years are different. To align the financial years, they should apply to the FTA. Here, in this case, company A can change its financial year to that of company B, or company B can change financial year to that of company A. So both options are possible. So whichever is beneficial, or they can choose. In the first case, if company A wants to change its financial year to that of a company B that is ending on 31st August, it can do. But the first tax group, tax period for a tax group starts from 1st September 2025. In case of second, if company B wants to change this tax period to that of a company A that is ending on 31st December, then in that case, the tax period for the tax group starts from 1st January 2025. So if you see in both the cases, the beneficial thing is the second case, where they can start forming a tax group from 1st January 2025 instead of 1st September 2025. So it is better company B changes tax group to that of a company A. So with this, we have completed all the examples with respect to the condition eligibility conditions.
Yeah. So friends, there are only two things which is left, which as far as the tax groups are concerned. So I just want to quickly take through. So one is how any company, a new company, can join a tax group, and how anybody can leave the tax group, and what are the transfer pricing compliance to be made in the tax group. So let us first talk about the how we can form a tax group. I have already told you each company has to be registered separately, and then by 31st of December or before the end of the tax period, they have to elect and they have to select. However, from the next year onwards, it is an exemption or it is a relaxation which is given only for the purpose of first year, because the FTA want to liberalize it. But from next year onwards, if any new entity which forms part of the tax group, they has to form part of the tax group before the start of the tax period. So for example, if the tax period starts from 1st of January 2024, ends on 31st December 24, and the company have acquired a new company during the year, then they have two provisions. So whether that form part of the tax group or that can join an existing tax group or not, so they have two conditions. One, if it is a new company, so a group have opened a new license which is altogether there does not exist before that, then they have allowed this new license to be added to the existing tax group from the day of formation itself. So for example, if a new company is being incorporated today, it is 1st of June 2024, then yes, that company can form part of the tax group from today itself, because it is a new license which have been added. But if the group have acquired 95% or more of an existing company, or I do some kind of a restructuring, by part of the share capital is owned by my owner, now I change it, I've created a holding subsidiary structure, or I have acquired another company 95% or more during 2024. So the law says that cannot form part of the tax group for the tax year 2024. And I need to add it to the tax group before 1st of January 2025, and that will create a tax group from the next year. So that is very, very important, friends, to understand that any new company which is not a newly incorporated entity, which have been acquired during the year, will be added to the tax group from the next year onward. Now, if there is already an entity which is a part of the tax group and that entity want to exit the tax group, so we have created a tax group of, let's say, 25 companies, and one of the company is being sold by me, or that company do not want to be part of the tax group. They said yes, they can apply to the FTA for deregistration of that particular company from a tax group, but the deregistration will be effective from the first day of the tax year in which they have applied for deregistration. So if I applied a deregistration, let's say on 1st of June 2024, then my effective date would be 1st of January 2024. So whenever there is an exit from a tax group, that exit will happen from the first day of the tax year in which I have gone for exit. Whenever there is an addition to the tax group, that addition will happen from the next year. The next tax year, whatever is the first day of that next tax year, from that day, there will be an addition. Meaning thereby that during the year, whatever company it is, if they are exiting the group, they have to file the return individually. Similarly, if there is an addition to the tax group, that company has to file the return individually for that year. From the next year onwards, their financial will be merged and consolidated in the tax group, and they are not liable to file the tax returns from the next year onward. That is very, very important part, because many companies may form part of tax group, many companies may join tax group, many companies will exit tax group. So that is one of the important tasks that one has to keep in mind. Whenever somebody joins the tax group or someone exited the tax group, then what will happen? So that's an important part one has to look into it. Next. The next and the last part that I just want to do in this session, because we have already crossed 1 hour time, and some of the feedback that we got that the session should not be more than 1 hour or 1 hour 15-20 minutes. So that's why we are keeping this sessions now onwards only for 1 hour and remaining time for the Q&A sessions. So the last part which is coming, and many people are asking and confused about the transfer pricing provision, because FTA at some part they say that whenever there is a group, within the group there is no FTA, there is no transfer pricing compliance to be made. However, another way it said yes, for certain transaction you have to go and do the transfer pricing compliance even if it is within the group. And many professionals are of different view that if there is a group consists of, let's say, 25 entities, and there is an intercompany transaction which is going on in the group, whether they have to go for master file, local file, or they need to do a compliance of the transfer pricing or not. So that is a big confusion which is there as far as transfer pricing within the tax group is concerned. Sir, the answer to this query is, whenever there is a transaction between the tax group entities which got nullified during the consolidation. So one entity sold goods to another entity, so it got nullified when we do a consolidation. So those transactions which are got nullified in entirety or in entirely they got nullified, so there is no requirement of doing any transfer pricing compliance. If it do not get nullified, how? Company A of the tax group sold goods to company B of the tax group. Company B capitalized those goods in their books of account. So sales of company A becomes the capital purchase of company B. So here it is a revenue item, there it is a capital item. Or there are other kinds of a transaction which do not get nullified during this consolidation process. So FTA have identified 4 kinds of these transactions. So one company have paid interest to another company, but the project have not started, so that got capitalized. Like sale, I have already given you. So all these kind of transactions which do not get nullified, the tax group entities, even if they are filing single consolidated return, but they need to adhere with all transfer pricing guidelines, and all transfer pricing compliance needs to be made in these kinds of transactions which do not get nullified among the transactions. Now somebody have asked me that one company has given dividend to another company. So in that case, can we apply a transfer pricing guidelines? Answer is there is no need. Why? Because that dividend once paid by one to another company in a group, that got nullified automatically. Or moreover, the dividend itself is an exempt income provided it is within UAE, or it is subject to complying with the participation exemption. And in case of an exempt income, we do not apply transfer pricing regulations generally. So that's how. So these transactions are also not subject to transfer pricing compliance. So this is what we want to do with the text group. So friends, this is all from our side on the text group. If you have any questions, so please write it. Swami, can you unshare the presentation, please? Or take out the last slide. So friends, if you have any questions, anything, you can be in touch with us. And now we can read the questions, or if anybody wants to ask a question in person, so please raise your hand. We will unmute you. Swami.
Yeah, so Mohammed Walid has raised his hand. I'm just allowing him.
Yeah, please allow him. Yeah, Mr. Mohammed Walid, you can unmute and you can ask your question.
Yeah, he is not asking. So we will go to next person, Sanjay, Mr. Sanjay Kumar.
Yeah, hi sir, you can hear me?
Yes, we can hear you, sir.
Okay, I just want to ask, sir, might be this question is not related to the group reporting, but what would be the sir tax for the purpose of tax for the foreign source of income? For example, there is a subsidiary in Saudi company or in other company, so that is a foreign source of income. So we have to include that also, and we have to pay the tax of the foreign source of income on the UAE.
Sir, you're on mute.
Yeah, you are in mute, sir.
Yeah, please come again once again.
Sir, if there is, for example, if the UAE company has a subsidiary company in other company, okay, rest of the world, so that rest of the world income also has to be included in the UAE company?
No, sir, no. Sir, in the what we have to see that the company which is outside UAE, whether this company have any place of effective management in India, in UAE. If answer is yes, then yes, they are liable to pay tax in UAE. But if there is no place of effective management, the second test what we have to do is whether that foreign company or the company which is incorporated outside UAE have any kind of a permanent establishment in UAE, or they have any nexus of any income in UAE. If answer is yes, then again they have to pay tax only on that income, not as a whole. And the third case is they do not have a permanent establishment, they do not have any place of effective management, then these foreign companies are not required to pay any tax in UAE.
Okay, thank you, sir.
Okay, next. Swami, I think there are some questions in the Q&A. Can you read it out?
Yeah, I'm just reading.
You are on mute.
I think first question you have answered now. This is generic question. So is it possible to have separate session for transfer pricing in details?
Yeah, sir. We will have separate sessions on transfer pricing. So it is a series of programs. Every month we used to do one program. So be connected with us, be associated with us. All those who have already participated, we will be sending information to all of you. Our office will be in touch with you, and you can join our sessions anytime on.
Yes, sir.
And
So
transfer pricing also we will do. First, we will take it on free zone once again, and then we may go for a transfer pricing. No problem.
the next question is, please can you recap the benefits of forming tax group?
Yes. So the benefits of the tax group is less compliance, So for example, you have 10 companies, 20 companies, 50 companies. So you are liable to pay taxes in 50 names. You are liable to file 50 returns. You are liable to do a compliance of transfer pricing among those 50 companies. So that is a burdensome process which one has to do. So if we can create a tax group, then one return, one consolidated accounts, one tax payment, and everything one. What is the loss? The loss is each company is allowed a benefit of to 375,000 dirham. There is no tax. But if they form part of a tax group, then this limit is for the tax group, not for the individual entity. So you need to see that whether whether your aggregate turnover or your aggregate profits in individual entities are less than or more than that. You have to take a cost benefit analysis, because the moment you form part of the tax group, then collectively there is a 375% that you have to check. Another benefit is that if some entities are having losses, some entities are having profit within the tax group, when you consolidate them, so all losses, everything gets subsumed under one. Whenever there is an intercompany transaction within the tax group, no transfer pricing, no 30% interest limitation rule, nothing will apply in all those cases. So those are the benefits of a tax group. And people are going for a tax group because when they have more companies, then in those cases, they may not like to go for multiple returns, multiple accounts, multiple transfer pricing transactions, etc. So those are the benefits. The loss is only one, that is loss of the limit of 375,000 dirham for zero tax. Yeah, next, Swami.
That's it, sir. So there is one personal question that I am answering. I mean, through chat. Yeah.
No problem. So friends, anybody, if they have any other question, so we can answer the query. Please raise your hand and we can answer it. So I think no one have any query here. So everything is clear. So thank you very much, friends. I think there is one hand which have been raised. Can you unmute?
I think he's lowered his hand. I think he's not there. Yeah, Mr. Sanjay Kumar wants to ask. Yes, Mr. You can unmute.
Yeah, hi, sir.
Yes, sir. Yes, sir. Yeah, Mr. Sanjay, you are on mute.
Sorry, sir, for the VAT purpose, any transaction third country to third country is the out of scope for the UAE VAT purpose. The same is for the UAE, corporate tax also?
No, it is not like that.
Oh, okay, sir.
They are subject to tax in UAE.
Okay.
Okay, I think, friends, there is no other query which is there. So stay in touch with us. Stay in touch with our future webinars and our team, APT Global, Mr. Ayub, Mr. Sam Patel, myself, Swami, and other Jyoti and other people are there who will help you out in any other query. If you have any query, so you can just send an email back to us. We will reply you on email as well. And it's a kind of an initiative of learning and learning from the questions as well from our side. So both side learning is there. So stay in touch with us. So thank you very much for your patient time. And it will be next time also, we will try to wind up the session in one hour 20 minutes, not more than that. So stay in touch with us, and we will be there for more such sessions in future. So thank you, friends. Thank you very much.
So there is a request about the sharing PPT.
Yeah. So I think we will put our PPT on our website at www.aptglobal.globalforms.com. So you can download the PPT from our website. For anybody who want to take a personal copy of the PPT, you received an email from our side. Please reply it back. Jyoti, I request you that whosoever requested you, please send the PPT back to them.
Sure.
So So that is my request to you. So with this, Jyoti, please close down the webinar.
Yeah.